Yeah, yeah. Yes, Kate, I'll grab Kathy, Kimmy, Carl, Chris, and Cassandra from school. Yes, I know Corey has piano, and I'll get him there before Clarissa's ballet recital. I love you too, bye.
Hey Keith, is that a baby?
Yeah?
Wait, is that your baby?
No, look, I'm gonna level with you. I'm in over my head. I decided to get with a girl that has 8 kids.
Wow, that's a lot to handle. What's her name?
Kate.
So, are you meaning to tell me you were Keith and Kate plus 8?
Can you just let me know how much money I'm gonna get back from the child's tax credit?
What? Why? Don't tell me.
Hey, I'm not looking for judgment.
You just got with this girl for the child tax credits, didn't you?
I'm just looking at an alternative way to get my down payment on a vintage Corvette Stingray.
There are only 3 things certain in life: death, taxes, and that you'll subscribe to this channel after watching this video. Yes, taxes are a constant topic on this channel. Usually we spend an episode talking about a concept, explaining why it's important, and briefly on how you can take advantage. Today, we're gonna make like Mr. Beaker and switch up the formula. We're gonna focus on specific tactics you can use to reduce your tax liabilities, as opposed to the concept of tax liabilities themselves. Now, tax liability isn't your ability to lie about your taxes. Tax liabilities is the amount of money that you or an entity owe to the government in the form of taxes. You may be saying, "The doy, Big Eith." But listen, there are people watching this video right now who may not know what a Roth IRA is. And we've literally mentioned that word on this channel 104 times. 104 times, which is not to be confused by a Koff IRA, which is when a group of Irish Republican Army members get a case of COVID. So we need to slow things down for the newbies out there. And just so you know, we love you newbies. Also, go watch those videos. They'll be helpful. Speaking of helpful, if we're moving forward with any of these strategies, I would highly recommend you speak with a certified public accountant or a certified financial planner. You know, somebody like little old me. People like us can take a look at your current financial situation and help guide your path. All right, enough stalling. Let's talk turkey. I mean, taxes. Now, this first one is fairly simple. It doesn't take a lot of commitment, but have you thought about getting married? You see, when you file your taxes, there's that pesky box that reminds you you're single and live alone. Those boxes are your filing status. They include options such as single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse, which is a list of things that I'm not sure which is the worst one. However, when it comes to reducing tax liabilities, some on paper are better than others. Filing status can significantly impact how much you're paying in taxes, as it determines the tax brackets and rates applied to your income. For example, as if endlessly swiping on a dating app in your underwear is not depressing enough, the American tax system will tax you even more for being seemingly unlovable. Talk about kicking somebody while they're down. Individuals that file single typically face higher tax rates compared to those that are married filing jointly, where income thresholds for each tax bracket are generally higher. Filing status also influences eligibility for various tax credits and deductions. For example, head of household filers benefit from more favorable tax brackets and access to more tax credits. So basically, what I'm telling you is for you to either take care of some kids or get married. Whether that's your lover or best friend, that's up to you. This next tactic is the gift that keeps on giving, or the giving that keeps you gifting. Giving financial gifts to loved ones in certain ways and charitable organizations can help keep your tax liability low. This can be especially helpful for lowering your estate taxes. You know, the ones that you pay when you move on to the big riverboat casino in the sky. In the US, individuals are allowed to gift up to a certain amount each year to any recipient without incurring gift tax. In 2024, the annual amount that you can gift to a person is $17,000. Additionally, gifts to spouses and charitable organizations are generally exempt from gift tax. You probably often heard the best time to raise money for charity is during the holiday season. Probably because the spirit of the season infests all of our brains to be charitable, right? Well, sure, but
hold your horses. Giving financially before the end of the year can really help with your taxes as well. By accelerating deductions into the current year, you can increase your overall deductions, potentially reducing your taxable income for that year. So if you need to purchase things for your business or want to give to charity, this can give you more potential deductions, thus saving you money on your taxes. Conversely, say you're about to land a big contract where you stand to make a good chunk of change in a year where you already made a large amount of income. It might be best to wait to get paid till the following year. By deferring income to the following year, you can reduce your current year's taxable income, potentially keeping you in a lower bracket. For example, if you anticipate higher expenses or charitable contributions, paying them in advance can maximize their impact on your tax return. Similarly, if you expect a lower income in the following year, it might be beneficial to defer significant income, such as bonuses or that big contract you're waiting on, to take advantage of potentially lower tax rates. Now we've gone over and over and over and over and over why investing can be so crucial for your future financial success. But something we haven't talked about is how certain accounts help reduce your annual tax liabilities. These include things like traditional IRAs, 401ks, 403bs, but also include HSAs, which, if you don't know what any of those things mean, that's totally normal. It's like walking into a Yu-Gi-Oh tournament. But luckily, we have a video for each of those topics that you can check out here. Now the beauty is contributions to all accounts can yield some sort of tax benefit. 401k and 403b contributions are often tax deferred, which means you don't pay taxes until you take the money out. Accounts like traditional IRAs and HSAs offer you the benefit that the contributions are potentially tax deductible, meaning that if you want to employ that tactic we just learned, you can contribute money to these accounts before the cutoff to add some deductions and to add to your retirement and potential health expenses down the line. Now, we've covered just a few of the ways that you can limit your tax liability, but there are probably dozens more. Well, anyway, that's our show. Thanks for watching. And remember, death and taxes may be certain, but taking care of 8 kids can certainly be taxing. We'll see you next time.